Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook. Today is Monday, 10th of December 2012. We are coming closer to the end of the year of 2012. The main highlights of the beginning of the week basically were triggered yesterday on last Friday on better than expected U.S. Jobs data that turned the sentiment in the market and pushed the dollar higher, as the greenback gained versus the most of major, continuing basically for the third consecutive day, boosted by U.S. better than expected unemployment data that showed increase of 146,000 jobs last month, and showing a little apparent impact from Superstorm Sandy that was basically expected to drop the job picture for the month of November, and the jobless rate stayed to a near 4-week low at 7.9%. Basically, the euro came under increased pressure after the data, as following the broader weaknesses on the reversal from 131.25, and the starts this week again with the gap lower open, currently hovering around 129, but quite bleak outlook for the near term sees more focus towards the downside, with a similar situation on the sterling that is also just holding above 160 last Friday's low and psychological support. On the back of better than expected the U.S. job numbers released last Friday, that basically pushed the euro to the lowest level in 7 days. The sellers again found another reason to push the price lower at the beginning of this week, as Italian Prime Minister Mario Monti surprisingly announced his resignation, his intention to resign last Saturday. The bomb has heightened the fears of a political crisis in Italy, with the early elections likely to be set on in February, shortly after the country's 2013 budget approved through the parliament, according to the Mr. Monti's comments. The prospect for euro is, as I said, quite negative at this point, as we have several events that basically impacted the single currency and push it lower. As said, the outlook remains quite weak for today, with the test of possible extension down towards 128.20, quite strong support seen as a likely near-term scenario, with some corrective consolidative action not promising much towards the upside. Briefly look at the other majors. Dollar yen is again basically failed to clear the upper boundary of 82.80, 81.70 range, holding currently around at 82.30, still above 82.20 support, and the positive tone established now in the near-term studies sees more potential towards upper boundaries, but of course a break above 83 is required to resume the broader rally from 79.06, while dollar Swiss is consolidating recent gains that peaked at 93.80 last Friday, holding positive momentum following break above 93 and 93.40 barriers, and keeping immediate focus at 94 as psychological barrier, and 94.20 200 days moving average. It's important if the any corrective action holds above 93.20.25. That is quite good support. Oil remains pressured. Still brief consolidation is seen above $86 per barrel, following a break last Friday to as low as 85.67. Basically, again, the oil price is approaching the lower boundary of the recent, I would say, range, with more focus seen towards the upside, bringing risk down to 85.00 and 84 as a key support for the oil price, following the upside rejection at 90.31, where the channel resistance blocked the price from testing levels above and the sustaining break above 90 as a psychological barrier. Gold gets supported by positive jobs data, bouncing from a dangerous area after posting a fresh low last Friday at 1684. I mean, just testing the previous two lows, bouncing above 1700, and now testing important barriers at 1710, 1712. A break of which would bring some more prospect in the near term for some corrective action, but still the outlook remains quite weak for the gold as yellow metal hit the levels, broke below psychological 1700 support and hit levels below this with the near-term basing attempt now seen underway, but still a lot of work required to improve the near-term structure for the gold. From today's calendar, releases already seen from Australia. Home loans for October came at disappointing only 0.1 compared to 3.1 forecast. China's new loans again disappointing 19.6 billion compared to 32 billion in October and 26.7 billion in forecast. Japan consumer confidence dipped below the previous release of October. Release today is 39.4 compared to 39.7 previous month and 40.3 more optimistic forecast. German trade balance again came below the expectations. 15.2 billion euros surplus is today's release compared to 15.9 billion surplus forecast and 17 billion in the month of September. Industrial production from France and Italy, French one came at better than expected 0.4% at 0.7 was today's release, and quite negative September's release at minus 2.7. Italian one is still to come, and more significant, I would say, is the Centix investor confidence for December for a Eurozone that is forecasted slight improvement, though still in the negative zone. Minus 16.2 is the forecast compared to minus 18.2 in month of November. From Americas, only Canadian housing starts for November is due at 13:15 GMT with 202,000 units seen in the month of November, slightly below the October's release at 207,000. And the Bank of England Governor Mervyn King is due to have speech at 17:15 late afternoon today, and this is all from today's calendar. I think we should now move to the technicals and see. Most of you are looking for the outlook for the coming day as this is basically the most important part for most of the traders. As shown on the hourly chart, Euro maintains negative sentiment of 131.25 peak of last week, 5th of December, with the lowest level so far seen at 128.76 last Friday's low, and brief recovery being capped at 129.50. Gap lower opening this morning, still failing to cover the gap. Let me just 129.19 basically did nearly cover the gap. We might see some consolidation as hourly indicators started slightly to point higher, but overall negative tone better shown on the 4-hour chart as we retraced over 50% of the initial rally from 126.60 to 131.25. Now sees more prospect towards the downside. Further consolidation is not ruled out at this point as the pair is attempting to fill the gap with a good barrier at 129.50. This is last Friday's intraday high, and 129.71 last Friday high, with the bearish crossover of 20 over 55 days exponential moving averages seen capping the upside. For now, only break above these levels, and probably regain of 130.00 that acts as a psychological barrier, and also 50% retracement of the latest downleg from 131.25 to 128.76 would provide near-term relief and avert immediate downside risk. As said, initial barrier at 128.70 so far is seen capping the downside, with more focus seen towards the downside with break below 128.76. This is also low of 28th of November 2012. Seen targeting 61.8% retracement at 128.38, and then we have 128.25 zone, where is the daily Ichimoku cloud base, as well as main bull trend line of 120.42 yearly low posted on the 24th of July, seeing as a break point. The loss of these levels and the psychological 128.00 would likely look for a test of 200 days moving average that is close to this area, currently at 127.83. In the near term, yes, we can expect some consolidative action before the pair resumes lower. Only break above 130 would provide relief and avert immediate downside risk for the euro dollar. Sterling is attempting to consolidate above 160, but bears, as shown on the hourly chart, are still in control. 4-hour ADX also shows bears dominating, seeing more potential towards the downside following last Friday's dip to 160.00 psychological support that so far contained the dips, and a brief recovery attempt being capped at 160.42. This is also the 55 days exponential moving average on the 4-hour chart, with the 10 days one crossing below 55 days one, putting additional pressure on the pair. A negative tone still dominating on the 4-hour on the hourly chart, with the lack of momentum for some stronger corrective action, seeing again more potential towards the downside unless we see break above 160.60. that is last Friday's high, and approximately 50% retracement of the down move from 161.27 to 160.00 so far. More prospect seen towards the downside as break below 160.00 would confirm the double top at 161.29.27 as a bearish pattern would likely trigger some stronger corrective action. Immediate support we have at 158.59.87. This was basically close to this 160. It was reached so far 159.87, 30th of December low, and 50% retracement at 159.78. ahead of 159.60, 28th of November low. These would be the immediate downside targets, as 4-hour indicators are now firmly in the negative territory. More focus again, I would say, seen towards the downside, with further consolidation above 160 seen as a likely scenario, but only break above 160.60 would provide relief and probably signal near-term basing and prevent immediate downside risk. However, the reversal of 161.29.27 sees now more potential towards the downside, as daily studies are again losing momentum, and the sharp decline of the stochastic, as the pair also returns below the broken bear trend line of 163.08, sees more focus in the near term towards the downside. The daily Ichimoku cloud base at 160.31 has been cracked, and this is another bearish signal for the pair, though the Tenkan-sen line is still within the cloud but holding above the price, while the Kijun-sen is below the price. We need to see the break below 159.80, which is our initial support, in order to confirm the bearish structure and confirm the double top for fresh extension lower. 159, we said 159.60, and then 61.8% retracement at 159.42 could be the downside targets in the near term. Dollar yen, again, failure to clear the upper boundary of 82, 83, 81.70 range, with last Friday's spike to 82.82 did not result in the clear break, and the regain of 83.00 as our relevant level and the break point. Immediate pullback and the lower top at 82.63 now again puts the more pressure towards the downside, as hourly indicators are losing traction, attempting below their midlines. That turns immediate target to the downside 82.20 zone. Lows of last Friday coming to focus, loss of which would again shift focus down towards the round figure support at 82.00 and the range floor at 81.71. Still positive tone seen on the 4-hour chart, but again indicators started to point lower. RSI and the rate of ROC 14 is they are below their 7 days moving averages, seeing a more again potential stochastic already in the down move, seeing again a risk towards the downside, basically seeing a potential for further range trading that would increase downside risk on a loss of 82.00 psychological support. As said, initial support is 82.20, last Friday's low, reinforced by 55 days exponential moving average on the 4-hour chart that currently starts to move sideways. That is again keeping the upside protected for now. Narrow range of approximately 110 points is still in play with more sideways movements. Of course, loss of 82.00 is set to reintroduce the lower boundaries, while break below 81.70 would be signal for a stronger corrective action of the latest upleg from 79.06 to 82.83, with the 81.40, 38.2% retracement seen as immediate target in case of break below 81.70 range floor. And the dollar Swiss is consolidating its recent rallies as last Friday's spike higher hit 893.81, with subsequent dip down to 93.25 that contained the downside. The overnight's gap higher opening did not give much result so far, as the pair managed to fill the gap. Further consolidation is seen quite likely, with important 93.20 zone reinforced by 55 days exponential moving average. 93.25, 93.17 and 93.28 is the moving average expected to contain dips in order to keep the near-term bulls in play following break above important 93.00 and 93.40, as the rally retraced so far over 50% of initial down move from 95.11 down to 92.39, which is the recent low posted on 3rd of December 2012. More positive tone is seen on the 4-hour chart, as bullish crossover of 20 over 55 days exponential moving averages at 93 now underpins the advance. However, a reversal of overbought territory, as RSI is already pointing lower, might be a signal for further consolidative action. It's important to hold above 93.20 in order to keep immediate bulls in play for possible stronger recovery, and recovery requires basically break through important 94.00, which is round figure resistance, also near 61.8% retracement, as well as 94.20, the 200 days moving average, break of which is basically required to signal the top at we have 93, 92, 37, 13 and 39 in order to possibly reattract the upper boundaries. 93.30 zone is the initial one, 94.30 is the initial one, probably to refocus 95 and 95.11. Descending 90 days moving average, an attempt to create that cross on crossing below 200 days moving average could be the negative factor at this point, and could limit gains for the pair. So far, the near-term structure, as said, remains quite positive, but further consolidation is seen likely, as divergence shown on the hourly chart of RSI and the MACD, as well as momentum, sees increased downside risk. A break below 93.20 and 93.00 would again bring the bears in play, and they probably will focus again the recent lows at 92.40 zone. That will be signal of possible resumption of the broader downtrend from 95.11, and possible test of our key support at 92.13, low of 17th of October 2012. And from the commodities, gold is in improving phase currently, following a triple rejection at 1684.85 zone. Last Friday spike lower, hit 1684 and then bounced higher. A regain of important 1700 and now 1705 and 1710 barriers keeps now more prospect towards the downside, as the yellow metal retraces approximately 38.2%. This is the initial barrier. Previous lows 38.2% Fibonacci retracement of down move from 1752 to 1684, as well as a 55 days exponential moving average that currently started to move sideways, with the reversing 20 days one now underpinning the advance. As the 4-hour indicators are attempting or already above their midlines, at this point more prospect is seen for further recovery for the yellow metal. Immediate barrier, we have only clear break above 17. 10 level, we have 1718, the 50% retracement, and then 1722 lower top of 3rd of December 2012. Basically, if we see break above these levels, then the immediate downside risk would be averted, and the risk of posting a lower top and fresh extension lower will be reduced in favor of a stronger recovery, where we have 1726, 61.8% retracement, and 1731 high of 30th of November 2012. Failure to regain 1722, I would say, is our relevant level, would again keep more risk towards the downside, as larger picture outlook is still quite negative, as shown on the daily chart, but reversal of stochastic and the RSI starting to point higher gives some more credibility to the current bounce of 1684 zone, with break above 1713 as initial barrier. 90 days moving average seen possibly opening a way towards 1722, our key near-term barrier on the upside, break of which, of course, to confirm the near-term base at 1684 basically will confirm the triple bottom, and as a bullish pattern would be signaling a more focus towards the upside. The recent data set from US yesterday, last Friday's jobs data, are now supportive for the yellow metal. And finally, the crude oil again is under pressure with the consolidation seen above 86.00, but quite negative toast is still seen on the lower time frames, with the all indicators holding in the negative territory. Does not see much prospect towards the upside, as basically the oil price cracked the channel support we mentioned in our last Friday's comments, that important support is this channel support at approximately 86.00, break of which that already occurred now to 85 and down to 85.67, keeps focus on the 85.35 low of 28th of November. That will open way towards 85.00, and finally towards 84.05 low of 7th of November 2012. Any corrective actions see quite a good barrier at 86.89. This is last Friday's high, reinforced by descending 20 days exponential moving average. Basically, if we see the break above above 87, that could be a signal for some stronger recovery. Otherwise, not much prospect seen on towards the upside, as the near-term structure is still weak, with only 23.6 being percent being retraced so far on last Friday's bounce to 86.89. I would say at this point more prospects seen towards the downside, as daily structure is again lacking momentum, and most of indicators pointing lower, keeping the risk on the downside, with the daily Ichimoku cloud base at 89, now firmly capping at 88, firmly capping the downside, and the Ichimoku studies, although the price holds below both indicators, though the Tenkan-sen is above the Kijun-sen, still seeing more downside pressure in the near term for the crude oil price. That was all from my side. If you have any questions, you can submit them now. If you want any other instrument to take a look at, please, you can type and submit your questions or suggestions. Okay, we have a question for Euro Yen that has a similar behavior like Euro Dollar. Let's take a look on the daily chart that shows still the uptrend quite intact of 94.22 low of 24th of July with 76.4 being levels being over 76.4 being retraced of the down leg from 111.42 peak of 2012 down to 94.10 yearly low with the near term with the larger uptrend still being intact. On the I apologize, we have small problem. On the 4-hour chart, loss of traction shown on the indicators breaking below the midlines and the price holding below 55 and 20 days moving average following a pullback from 107.94 last week's high. Failure basically to regain 108. That was our initial target. Now keeps more focused towards the downside and opens way for some stronger corrective action. From the Fibonacci levels, we have retraced so far from 100.31 to 107.94, approximately 23.6% at low at 106.11, with the daily structure also being negative. We might see some consolidation. This is similar to Euro of 106.11 last Friday's low, but still the focus is more towards the downside as the studies maintain a negative tone and see more focus towards the downside as a break below 106.11 will open the next significant static support at 105.26. This is the low of 28th of November, and the 105 as a round figure support and 38.2% retracement seen as a break point for possible stronger corrective action. Anything above 105.26 I would say would be still seen as a brief corrective consolidative action as a part of the larger uptrend, while a break below 105 could be quite risky, as this would risk a deeper reversal. As we said, for Euro also the further consolidation is likely, but overall negative tone still sees more focus towards the downside, with the daily studies now emerging off the overbought territory, all indicators pointing lower with sharp decline of stochastic, seeing I would say more prospect for some stronger corrective action. As we said, the levels 105.26 and 105 seen as initial. Any further question, please? Okay, no questions. Okay, I would like to thank you all for being with us. Hopefully, we hope that, and I believe that we provide you good information for your trading, and expect you, of course, tomorrow morning at the same time at 8 o'clock GMT to be with us when we will come with the fresh updates. Until then, I wish you a very nice Monday as the beginning of the week, and a good and successful week. Of course, with your trades all to be in the positive territory. Good luck.